Hey everyone, it's Prashant here. Welcome to my YouTube channel and thank you for joining me in today's video. Let's dive right in. Have you ever tried to sit down after finally deciding to start saving for retirement and immediately been hit by a bunch of terms that you didn't understand and gotten a headache? IRA, Roth IRA, tax deferred, 403b, 401k, tax sheltered. Oh my God! Saving for retirement in America is confusing, not to mention complex. In today's video, I'm going to be talking about several different types of retirement accounts, their purposes, their advantages and disadvantages. In addition, towards the end of the video, I'm going to be telling you exactly what I do at this point in my life to save for retirement. Keep watching till the end. Guys, before we continue with this video, I want to take a second to ask you to hit that like button and the subscribe button. This helps me out a lot with the YouTube algorithm and motivates me to keep making these videos. That being said, let's talk about retirement accounts. Before we discuss different types of retirement accounts, let us first talk about what a retirement account is. A retirement account is a special type of account designed by the government specifically to help people save for retirement. These accounts offer account holders special benefits primarily in the form of tax incentives. The IRS provides tax breaks because the government wants people to save for retirement. People who retire with large nest eggs tend to require less assistance from the government in terms of food assistance or housing assistance in retirement. On top of that, people who are wealthy in retirement tend to spend more money, which boosts local economies where the retirees live. It's a win-win situation. There are two broad categories of retirement accounts, tax-deferred accounts and tax-exempt accounts. In this video, I'm going to be talking about both of those types one by one. First, let's talk about tax-deferred accounts. These type of accounts give you a tax benefit now when you save or contribute towards your retirement. When you contribute towards a tax-deferred account, typically you can deduct that contribution from your income on your federal income tax. For example, if you made $60,000 a year and you made a contribution of $10,000 into a tax-deferred account, you can typically deduct that $10,000 against your income and be taxed on an income of just $50,000. This can greatly lower your tax burden and is a great benefit to most savers. However, when you withdraw money from this account in retirement, it is taxed as ordinary income. For example, if you have a side hustle in retirement that makes you $20,000 a year, and on top of that you withdraw $40,000 a year from a tax-deferred account, you will be taxed on the entire $60,000 as if it's regular income. As you can see, these type of accounts delay taxation from now when you contribute the funds to then when you withdraw the funds. This is why they're called tax-deferred accounts. The most common examples of tax-deferred accounts in the US are a 401k, a 403b, and traditional IRAs. Let's talk a little bit more about these types of accounts. 401k and 403b. First, let us talk about the 401k and 403b tax-deferred accounts. Both the 401k and the 403b are employer-sponsored accounts. This means that any plan participant must be an employee of an organization or a company that offers these accounts. The main difference between a 401k and a 403b is that a 401k plan is offered by a for-profit company, whereas a 403b can be offered by a not-for-profit company or government entities such as city or state governments. In both cases, the employer chooses a brokerage to administer these accounts such as Fidelity or Vanguard. Employees then have an option of choosing their investments from a menu of predetermined options. They do not have the option of going and investing in other stocks or other securities outside of these available options. Typically, the options include mutual funds, target date funds, and index funds. The biggest advantage of a 401k or 403b plan is that employers often match the contributions that an employee makes towards their retirement plan. Employers are not required to do this, but will often offer this as part of their benefits package in competitive labor markets. Examples of employer match are as follows. First, 50% match of employer contributions up to 3%. This means that the employer will put 50 cents for each $1 that you contribute till that contribution reaches 3% of your total salary. Or a dollar for dollar match up to 6%. This means that the employer will put $1 for every dollar you put until their contribution reaches 6% of your total salary. There are certain rules that must be followed when it comes to a 401k or a 403b account. First, you must be an employee of a company or organization that offers such an account, and you must be at least 21 years of age. Second, there are certain contribution limits imposed by the IRS every year. For the year of 2021, your contributions cannot exceed $19,500. If you're above the age of 50, you can contribute an additional $6,500 in catch-up contributions. Third, withdrawals are not allowed before you reach the age of 59 and a half years. If you withdraw any money before you reach the age of 59 and a half years, a 10% penalty will be applied and any withdrawals will be taxed. And finally, once you reach the age of 72 years, you must withdraw your money. This is called a required minimum distribution or RMD. RMD amounts are set by the IRS for every year. Now let us talk about another type of tax deferred account, the traditional individual retirement account or traditional IRA. Traditional IRA accounts are individual retirement accounts that are not tied to any companies. Any individual can open one of these accounts with a brokerage firm such as Fidelity or Vanguard, fund it with earned income, and then invest the money as they like. Contributions made to traditional IRA accounts are often tax deductible also under certain conditions. As with 401k accounts, there are certain rules that apply when it comes to traditional IRA accounts. Let's take a look. First, contributions must be made using earned income. This means that you must earn at least as much money as you're contributing to your traditional IRA account in that tax year. Second, there are contribution limits when it comes to traditional IRAs. For the year of 2021, the IRS has set this limit at $6,000. If you're over the age of 50, you can contribute an additional $1,000. There are no income limits when it comes to qualifying for a traditional IRA. However, at higher income limits, the contributions that you make may not be tax deductible. As your earned income increases, the contributions that you can deduct against your taxes decreases from the full amount to a partial amount and then phases out completely. Just like a 401k, withdrawals are not allowed till a person reaches the age of 52 and a half years. If any withdrawals are made under this age, there is a penalty of 10% and taxes will apply on the withdrawals. There is an exception to this early withdrawal rule. Withdrawals of up to $10,000 to pay for a first home or for college expenses are allowed if certain conditions are met. Just like with 401ks, required minimum distributions must begin at the age of 72. Alright, now that we understand what tax deferred accounts are, let's move to tax exempt accounts. Tax exempt accounts offer a tax benefit in the future. Contributions to tax exempt accounts are not deductible against your income now. However, withdrawals made in the future in retirement are tax-free. The most common type of a tax exempt account in the US is a Roth IRA account. Some employers also offer a Roth 401k account, although these are pretty rare. These accounts mix the benefits of a 401k account as well as a Roth IRA account. Now let us talk about a Roth IRA account. A Roth IRA account is a special type of individual retirement account which is named after William Roth, a former US Senator who sponsored the legislation that formed the Roth IRA account. Contributions made towards a Roth IRA account are not tax deductible. However, investments made within the Roth IRA account can grow completely tax-free, and withdrawals later in retirement are also tax-free. Just like with the other type of retirement accounts, there are certain rules when it comes to a Roth IRA account. Let's look at that. First, contributions must be made using earned income. This means that you must earn at least as much money as you're putting into a Roth IRA. Second, there are contribution limits when it comes to Roth IRAs. The IRS has set the limit for 2021 at $6,000. If you're over the age of 50, you can contribute an additional $1,000 towards your Roth IRA. There are maximum income limits when it comes to qualifying for a Roth IRA. For a single individual, it is $140,000 per year. For a married couple filing jointly, it's $208,000 a year. And for a couple filing separately, it's just $10,000 a year. All of these numbers are for the year 2021. There is a backdoor Roth IRA for higher income earners, but that is something that I'm not going to be talking about at length in this video. In general, withdrawals are not allowed before the person reaches 52 and a half years of age. If withdrawals are made before this age, then a 10% penalty applies and taxes are due on the withdrawals. Just like with traditional IRAs, there are exceptions to the early withdrawal rule, including withdrawal of $10,000 to pay for a first home and withdrawals for college expenses. Unlike traditional IRAs or even 401k or 403b accounts, there are no RMD or required minimum distribution requirements. This means that you do not have to withdraw the money as long as you're alive if you don't need it. Alright, let's do a quick recap to make sure we completely understand everything we talked about. Number one, there are two main types of retirement accounts, tax deferred accounts and tax exempt accounts. Number two, contributions in tax deferred accounts are deductible in the year that you make those contributions. Withdrawals in retirement are taxed as regular income. Number three, contributions in tax exempt accounts are made with after-tax money and are not tax deductible when you make the contributions. Withdrawals in the future in retirement are tax-free. Number four, examples of tax deferred accounts are the 401k, the 403b, and the traditional IRA. The main example of a tax exempt account is a Roth IRA. Number five, there are certain rules that must be followed when it comes to retirement accounts. This includes tax-deferred accounts as well as tax-exempt accounts. These rules include eligibility requirements, contribution limits, and withdrawal limitations. Okay guys, just like I promised at the beginning of the video, now I'm going to talk about what my wife and I do when it comes to retirement accounts. First up, we both have Roth IRA accounts and we try our best to max this out and put $6,000 per year into these accounts. We use Vanguard for these accounts, which is my favorite brokerage when it comes to investing for the long term. Also, the Roth IRA is my favorite kind of retirement account because the investments grow tax-free and withdrawals in the future will also be tax-free. Second, I have a 401k account with my employer and my wife has a 403b account with her employer. We both contribute different amounts and percentages of our salaries to these accounts to make sure that we are comfortable with how much money we are saving for retirement and how much money is left over for our everyday expenses. Remember, pay yourself first. As far as what we actually invest in, we use a 3-fund portfolio which has been designed to give us good returns while keeping a risk profile that is tolerable to us. If you want to learn more about what a 3-fund portfolio is and how to use index funds for investing, you should watch my video on that topic. I will leave a link in the description box down below and link it up here. You should definitely go check out that video after this one. That's all I have for you guys in today's video. I hope you really enjoyed that video and found it informative and learned something when it comes to retirement accounts. Please hit the like and subscribe buttons down below and hit the bell icon to be notified instantly when I post a new video. I post at least one video every week with great new financial content, and I hope to see you back here. Also, go ahead and follow me on Instagram and Twitter. I will leave the handles in the description box below. Thank you so much for watching and see you next time.